iFinance 3320 students. This was a review of problems that are in the mock final exam. I've got quite a few that people have requested some help on, so let me go through them. First one is number 7. And you need to have this in front of you because I can't show the calculator and my work and also the problem at the same time if I zoom in. So you need to have it in front of you. Below is the common equity section of this technology company for the last 2 year-end balance sheets, and here are these numbers. Important to note the order. They've never paid a dividend to common stockholders. Which of the following statements is correct? Well, before even reading this, I can see that from 2008 to 2009, the common stock area went up, and that means they must have sold common stock. Retained earnings went down. Now, it says they never paid a dividend to their common stockholders, so what must have happened is they must have had a loss, and that's why their retained earnings declined. Total common equity is this sum. We can tell that their earnings in this year was negative 340, but we don't know anything about the 2008 earnings. So, which of the following statements is correct? The company's net income in 2009 was higher than 2008. Well, we don't know 2008. They issued common stock in 2009. Well, that's a definite. Market price doubled. We can't see anything about market prices here. Had positive net income in both 2008 and 9. Well, forget the rest of it because they clearly didn't in 2009, and we don't know what happened in 2008. And the company has more equity than debt on its balance sheet. Well, we don't see any debt, so how do we know? So the answer to that question is that they sold common stock in 2009. Okay, the next one is 12. And so let's go through this. I think it might be helpful to make a little fake balance sheet here. So we've got assets, and we've got liabilities and equity. And we've got current assets, and we've got fixed assets. And on the liability side, we've got current liabilities, we've got long-term liabilities, and we've got equity. And these sum to total assets, and this could be total liabilities here, and then equity here, and then total liabilities and equity here. Okay, so there, and there. Now, what does it say that they're doing here? They issued new common stock and used the proceeds to pay off some of the short-term notes payable. So the short-term notes payable, I will assume, are going to be current liabilities because they're short-term. So it says it has no effect on the company's total assets or operating income. Okay, so operating income, does that include interest? No. Which of the following effects would occur as a result of this action? Well, they are increasing the equity amount by selling new equity, and they're decreasing this current liability. So let's look at the possibilities. The current ratio increased. Well, the current ratio is current assets divided by current liabilities. Current assets didn't change, current liabilities went down, so that's a definite. So you can pretty much stop right there. The company's times interest earned ratio decreased. No, if anything, it would have increased. Basic earning power ratio increased. Well, basic earning power is EBIT over total assets, and total assets didn't change, and EBIT didn't change either because we don't consider EBIT doesn't include interest anyway. Company's debt ratio increased. Well, debt ratio is debt to assets, and debt actually went down, so it didn't increase, it decreased. So the answer is that the company's current ratio increased. That would be A. Next one is 21. Your father paid $10,000 for an investment that promises to pay $750 at the end of each of the next 5 years with a lump sum at the end of the 5th year. What's the expected rate of return on this investment? Well, actually, I can look at this and I can tell immediately that it's 7.5% because it's $10,000 to begin with, $750 every period, and $10,000 at the end. And $750 is 7.5% of 10,000. So this is going to work out to be 7.5%. But let's go ahead and work it out. And we've got 10,000 as our future value. I'm never going to be able to get these reflections off. 10,000 is our future value. 10,000 change signs as our present value. 750 as our payment, and 5 as our N. And now we can compute. Let's see, is that, if I've done everything, compute IY, and it's 7.5%. See, the next one is 25. The rate of return on a perpetuity. And actually, there's 26 was requested also. So let's just establish the formula for a perpetuity, and that is we see it one of two ways. Either we see it as the rate equals the payment. I'll just call it payment for perpetuity, equals the payment divided by the present value, or we can say the present value is equal to payment divided by the rate. Now in this case, $250 per year, we're solving for the present value, so that's this version here. So we're going to plug in $250 divided by 0.05, and 250 divided by 0.05 is equal to 5,000, and 5,000 would be our answer. Well, I skipped to 26. I also had 25. My bad. But the same formula, just turned around. What is the rate of return you would earn if you paid $950 for perpetuity that pays $85 per year? Okay, our payment is $85, and the the present value is $950. So 85 divided by 950 equals about 8.95%. And so that would be the answer there, A. The next one that was requested was 38. And let's see, they have $1,000 par value bonds, mature in 25 years. Nominal yield to maturity is 9.25%. Pay interest semi-annually, and they sell at $850. What's the bond's nominal annual coupon interest rate? So this is a fair problem because it involves all the items that fall into a bond problem. It's just that we don't normally solve for this one. Normally we're either solving for the price or the yield to maturity, but not the interest payment. So let's go ahead and work this out a little bit here. So I'm going to clear everything out, and I hope the calculator is actually showing up on the overhead here. $1,000 par value. So 1,000 is my future value. They mature in 25 years, but it's semi-annual. So 25 times 2 is 50, so 50 is going to be my N. The yield to maturity is 9.25%, the nominal yield to maturity. Well, remember, if we were doing this the other way, if we were solving for yield to maturity on a semi-annual basis, we would convert everything by double the number of periods, and we'd end up with a yield to maturity that is just for a semi-annual basis, and then we double it. So we're going to do the opposite here. We've got the nominal yield to maturity on an annual basis, and we're going to have it. So 9.25 divided by 2 equals 4.625, and that's going to be my IY. Let's see, what have I got? Recall future value, recall payment, that's what I'm solving for. Recall present value, I don't have my present value in here, it's 850. So 850, change signs, present value. Recall IY, recall N, and now I'm going to compute the payment. And the payment is 38.50. And that's on a semi-annual basis. Those are semi-annual coupons. So what I need to do is double that, and this gives me my annual amount. And when I divide my annual amount of coupon payment by the par value of 1,000 divided by 1,000 equals 7.70%. So there's our answer there. E. The next one is 40. And this is another one where we've got semi-annual. Go up here a little bit. See if that is visible. So number 40, we've got a 10-year maturity. Let's see. Yes, this is semi-annual. It's 10-year maturity, so that's going to end up being 20 periods. So clear everything out. 20 is my N. You know, some people like to put the numbers in a certain order. Like they always want to do the future value first, and then the payment, and then the present value, whatever. And other people just go in order. And if you just go in order, we've got a 10-year maturity, and 10 times 2 is 20. That's our N. 6.25% semi-annual coupon. Well, remember that is the annual amount, and we have to convert it to semi-annual. So 6.25 divided by 2 equals 3.125, and that's on a value of $1,000. So this is actually a percentage. So I'm going to divide this by 100. So that is our decimal version, and we're going to multiply that by 1,000, and that gives me 31.25 as my semi-annual payment. So that's our payment. The going rate is 4.75 based on semi-annual compounding. Okay, so we need to divide that by 2. 4.75 divided by 2 equals. Okay, so we've got that in there. Now we have everything. I think we have everything. We need to put that in as our I. So recall N is 20, recall I, recall payment, recall future value, and compute present value. And, well, obviously I did something wrong here. Let me see what I did wrong. Recall N is 20. Recall payment, 31.25. Recall par value, 1,000. And 4.75 divided by 2 equals, that's going to be my I. Compute present value. I don't know what button I hit wrong, but the answer is 1118.31. Okay, the next one is 42. Okay, so in order to accurately assess the capital structure of a firm, it is necessary to convert its balance sheet figures to a market value basis. KJM corporate balance sheet as of today is as follows. And they're asking about the bonds. Okay, so this is another bond problem. This is a mistake here. The bonds are $1,000 each, but in order to get to 10 million, there have to be 10,000 of them. So there are 10,000 bonds, not $10,000. Don't actually have to do that, but I'm going to solve it the way, the sort of straightforward way. 4% coupon payable semi-annually. Okay, so 4% coupon semi-annually on a $1,000 bond. I'm going to go ahead and put the 1,000 in first. 1,000 is my future value. Coupon is 4%, and that would be 40 per year or 20 every 6 months. So 4% times 1,000 is 40, divided by 2 is 20, so 20 is going to be my payment. Yield to maturity is 12%, and we'll change that to 6 because it's halved, so 6 is my I. We've got 10 years to go, and that's doubled to be 20, so 20 is my N. So I've got 20 as my N, I've got 6 as my rate, I've got payment of 20, where was I? Payment of 20, and future value is 1,000, and so now I'm going to compute the present value of a bond. So compute present value, and it's 541.20. So one bond with a $1,000 par value is now worth $541.20. And there are 10,000 of those bonds. So this is just $1,000 one bond, but there are $10 million worth of bonds. So that's 10,000 bonds. So I'm going to go ahead and change signs on this. Now multiply it by 10,000. And now I get 5,412,032. So answer is B. Let's see. Number 59 is the next one. Okay, this is a crossover problem, and I'm gonna show this sort of graphically. So, in the chapter that covers this, they showed crossover with NPV on the vertical axis and rates on the horizontal axis. And let's go ahead and draw this stuff in. So Project X has an IRR of 19%. Okay, so I'm going to put over here 19, and that's Project X. and project Y is 17%. So I'm going to put that 17% is Y. Same risk, same lives, same cash flows. If the weighted average cost of capital is 10%, project Y has a higher NPV than X. Well, I'm just going to go over here to 10%, and I'm going to put a couple of dots here. We don't know exactly how, we don't know anything about the cash flows except that they're constant. We don't know how big they are, so we have no idea what the NPV really is. But we can say that at 10%, I'm directly above the 10 here, at 10%, Y has a higher NPV, measured over here on this scale, has a higher NPV than X does. Well, here's X's IRR, and if we were to draw this, it would look something like this, where the X goes like this. So here's X at 19, and it's at 19 is 0 on the NPV scale because the internal rate of return is that rate that gives us a 0 NPV. So that's where X would be at a 19% discount rate. It would be at 0 NPV on the horizontal axis. And with Y, it would be at 17%. But at 10% for Y, it's up here. So if I were to draw this in, it would look something like this, only it should be a nice curve and it shouldn't sort of double up on itself. So what we're seeing here is that there's a crossover for Y and X that occurs somewhere between 10 and 17%. Now let's look at the question. Which of the following statements is correct? The crossover rate must be less than 10%. Well, we know that's not right. Crossover rate must be greater than 10%. Yeah. If it's 8%, project X will have a higher NPV. Well, at 8% here, project X, project Y, no, Y has the higher NPV. If it's 18%, Y will have the higher NPV. Well, at 18%, Y is actually in the negative. If you were to continue this down, Y would have a negative NPV and X would have a positive NPV. Project X is larger in the sense that it has higher initial cost. Well, we don't know that. So the answer is B. The crossover must be greater than 10%. Okay, next one is number 60. And we need discounted payback here. I'm just going to reproduce these numbers. Minus 950, yeah, 525, 485, 445, and 405. And this is over the time period, time 0, 1, 2, 3, and 4. And we want discounted payback. Well, that means we have to find out at what point we get back a present value dollar equal to 950. And we can look at these two. These two together, 425 plus 485 is what, 930? No. 910 is 910. So even after 2 years without any discounting, we haven't gotten there. So but this is a big enough number that I'm pretty sure at this discount rate of 10% that we're not going to be beyond the third period. So we're going to be somewhere between here and here. So let's calculate these values. Okay, 525 is a future value, and the discount rate is 10%. So 10 is my I. 1 is the number of periods. Compute present value is 477.27. So here we have cash flows here, and these are discounted cash flows, and these are cumulative cash flows. So after the first year, it's 477.27. So my preference is to do it the way I'm showing it. You can do it a different way if you want, but I prefer this way. So now we need to figure out what's the present value of this number. Currently I have as my future value 525, as my rate 10%, as my N 1 period, and now it's going to be 485. So 485 is my future value. 2 is going to be my N, but 10 is still going to be my rate. So as long as I can keep track of this, I can just leave my 10 in there and go ahead and compute the present value, and that present value is $400.83. And if we add that to, I'm going to change signs, oops. If we, no, that's no good. I'll start over. 400.83 plus 477.27 equals 878.10. So we haven't gotten to 950 yet, but it's clear that we're going to get to 950 sometime in the third year. So I'm going to put 445 as my future value. 3 is my N, and compute the present value, and it's 334.34. And now I'm going to add that to 878.10. Well, 878, I had that 334 as a negative number, so let's start that over again. 334.34 plus 878.1 equals 1212.44. So somewhere we get our 950th dollar somewhere between here and here. And again, the way I do it, I just think of it like this, and the distance between these two and the distance between this and 950. And the distance between this and 950 is 950 minus 878.10. And just doing it in my head, I can see that that's 71.90, but let's go ahead and calculate it. 950 minus 878.1 equals 71.90. So this distance from 878.10 to 950 is 71.90, and this distance between here and here is 334. We know that because we got 1212 by adding 334 to 878. So this number is 334.34. So now I'll redraw that just to try to make it a little bit neater. 878.10, and I'm putting the 950 closer to the 878 because I know 950 is closer to 878 than it is to 1212, and that's going to help remind me that this number better be closer to 2 than to 3. So 878.10, 1212.44, and I'm going to put 950 here, and the distance here 71.90, and the distance here 334.34. So my discounted payback period is 2, because we have to get past the end of the second period, is 2 plus 2 plus 7190 over 334.34, and 7190 divided by 334.34 is equal to 0.215051. We'll round that to 0.22. So it's equal to 2 plus 0.22, which is equal to 2.22. And so our answer over here is D, 2.22. I'm going to leave that there for a second. The next one is number 68. I'm going to get a drink up. It'll just be a second. Okay, 68 says, I've got two projects whose cash flows are shown below. Mutually exclusive, equally risky, not repeatable. That's to sort of warn you that this is not like one of the problems that at the end of the chapter there was a section that I said we're not going to cover these because nobody else is covering them. That's just to throw you off of that concern. The CE believes the IRR is the best selection criterion, while the CFO advocates NPV. Well, this is a finance text, and so the hero is bound to be the chief financial officer, not the CEO. So the decision is made by choosing the project with the higher IRR instead of the one with the higher NPV. How much, if any, value will be foregone? In other words, if you take the one with the highest IRR rather than the one with the highest NPV, how much NPV will you be losing by taking the one with the lower NPV rather than the one with the higher NPV? So all this requires is that we calculate the IRRs and NPVs for these to make sure we have them straight. And actually, you don't even have to do that, but we're going to. So I need to get into cash flows, clear everything out, go back in, and I see there's nothing in now. And I'm going to put my numbers in. I see the weighted average cost of capital is 7.5. So 1100, 1100, change signs, enter, down, 550, enter, down, down, 600, enter, down, down, 100, enter, down, down, and 100, enter, down, down. NPV, 7.5, enter, down, compute. And we get 8620 for NPV, and for our IRR compute, 12.24. Okay, let's get back into cash flows, clear everything out, get in, nothing there, and put these numbers in. 2700, change signs, enter, down, 650, enter, down, down, 725, enter, down, down, 800, and enter. I'm not sure if this is going to work since I hit the wrong key there. And 1400, enter, down, down. And then we want to do NPV, and it's 7.5, enter, down, compute. and it's 224.31, 224.31, and our IRR is 10.71. So the Chief Executive Officer says, let's take this one. And the Chief Financial Officer says, no, let's take this one. But if you suck up to the CEO and go with what the CEO wants to do, how much are you giving up in NPV? Well, it would be 224.31 minus 86.20, which equals 138.11. And you can see that the answer is 138.10. This is a rounding error issue. You'd never have numbers as close as these two in a multiple choice. So 138.11, good answer. Okay, we're going to go to 94. So you had the following data on 3 stocks. Got standard deviations and betas. Well, standard deviation is deemed to be total risk, and beta is systematic risk. We judge by beta when we have a portfolio, and when we add a stock to our portfolio, its beta will adjust our beta proportionately. So if we add a beta stock that's lower than the beta of our portfolio, it will lower the beta of our portfolio. If we're looking at a stock in isolation, that is, we're going to put all of our money in one stock, then beta is not really the thing that you would look at. Beta assumes that you are fully diversified and you're only looking at systematic risk, not total risk, but systematic risk. Standard deviation doesn't know anything about beta. It's just total risk. So this says if you're a strict minimizer, you would choose which one if it is to be held in isolation, and which one if it is to be held as part of a well-diversified portfolio. So in isolation, you would want the one with the smallest standard deviation, which would be B. And if you're in a portfolio, you'd want the one, because you're a risk minimizer, you'd want the one with the lowest beta, and that's this one. So B here and A here. So it's BA. The answer is C. Okay. What number was that? Okay. Next one is 97. Okay, unless I'm missing something. This is less involved than the information. It's one of these cases where there's more information than you actually need. If they're going to issue the bond at $1,000, and that's at par value, and if it's at 7%, then the yield to maturity is going to be 7%. So you have a 7% cost of debt, and the marginal tax rate is 40%, so the after-tax cost of debt would be 7% times 1 minus the tax rate, which is, the first version is 40%. So 7 times 1 minus 0.4 would be 4.20%. And if it were at 30%, it would be 7 times 1 minus 0.30, which would be 4.9%. So all we're doing is calculating our after-tax costs of debt, and the difference between these is 0.7. So in calculating the weighted average cost of capital, the after-tax cost of debt would be 0.7 higher if you use a 30% rate than if you use a 40% rate. So that answer is C. And the next one is 98. So I've got a whole series here of these. So is 98 showing here? Expects to earn $3.50 per share during the current year. Expected dividend payout is 65%. Expected constant dividend growth is 6%, and this common stock is selling for $32.50. New stock can be sold to the public at the current price, but a flotation cost of 5% would be incurred. What would be the cost of equity from the new common stock? Okay, so this is considering flotation. The first likely error by a lot of people would be not realizing that this is in time one, so it's in the current year, not the past year, so that's good. But that's earnings, it's not dividends. And this says the dividend payout ratio is 65%. So our dividend is going to be $3.50 times 65%. So in general, it's D1 over P0 plus G. With flotation costs, it's D1 over P0 times, that's a P, times 1 minus the flotation cost plus G. So for us, our D1 is equal to 3.50 times 0.65, and our stock is at $32.50, and flotation cost of 5%, so that's times 0.95, and then we're going to add a growth rate is 6%. Okay, so $3.5 times 0.65 is equal to, off the page, is equal to 2.275, and 32.5 times 0.95, is that the right flotation cost? 0.95 is equal to 30.875, and add that 0.06. So 2.275 divided by 30.875 equals this, plus 0.06 equals 0.1337. And that's this answer here, B. I was asked about several of these, so I'll just keep going with this. 99. Estimate the cost of common equity. Obtain the following data. D1. Now you don't have to calculate D1 from E1. Instead, it's given to you. But it's the same formula. D1 over P0 times 1 minus the flotation cost plus G, and in this case D1 is equal to 1.75, P0 is 42.5, and the flotation cost is 0.05. 1 minus 0.05 is 0.95. I should have just written 0.95. And then plus G, which is 0.07. So what I would do, and you may not want to do this, I'm going to multiply this out and then divide by this and then take the inverse. So that's the first. I'm going to do it that way, and then I'll do it the other way. So 42.5 times 0.95 equals, and I'm going to divide that by 1.75 and then take the inverse. So that is equal to 0.043344. I didn't actually have to add that in. And then I'm going to add 0.07 to that. So plus 0.07 equals 0.1133, and what am I on? Just numbered, 1133. Okay. This is a little redundant, but I was asked to do it, so I'm going to do it. We've got another flotation situation here. So I've got 1.25 divided by 27.50 times 0.94, because it's 6% flotation. And then I'm going to add to that the growth rate, which is 5%. I'm going to go ahead and do it this way. There. 27.5 times 0.94 divided by 1.25 equals, and then take the inverse, 0.04. I'm going to add 0.05 to that, and I get 0.0984. This answer C. So I'm going to show that again the way I did it, and again you don't need to do it this way, but I'm going to show it that way, and I'm going to show it the other way too. So what I did is I took this denominator, calculated it first, and then instead of dividing this by the numerator by the denominator, I divided the denominator by the numerator, but then I used the 1 over x key to switch it back. So 27.5 times 0.94 divided by 1.25 equals, and then inverse plus 0.05 equals 0.0984 rounded. Okay, you could do it that way, or you could say 27.5 times 0.94 equals 25.85. You could write it down, and then it's 1.25 over that plus 0.05. So 1.25 divided by 25.85. I'll hit the equal sign, you don't really have to. Equals this plus 0.05 equals 0.0984 again. Whichever one you like to do. Okay, this next one is not as easy as the earlier one. So to help finance a major expansion, they want to sell a non-callable bond, and that's just a callable bond would be more complicated. Several years ago, now has 20 years left to maturity, annual coupon, paid semi-annual, sells at a price of $10.75 with a par of $1,000. If the rate is 40%, what's the component cost of debt for use in the weighted average cost of capital calculation? So they're giving you the tax rate, and so we know we're looking for the after-tax cost of debt. And they're specifying it here when they say the component cost of debt for use in the weighted average cost of capital calculation, not the cost of debt, but the after-tax cost of debt. It doesn't say after-tax cost of debt here, but the way they phrase this, you need to realize that the component you would use in the calculation itself would be the after-tax version. So let's clear everything out here. And what do we have? We've got 20 years to maturity, but it's semi-annual, so we're going to call that 40. So 40 is our N. 9.25% annual coupon. Well, I know that that 9.25% would be $92.50 on a $1,000 bond. But I'll go ahead and multiply it out. 0.0925 times 1,000 equals, that's the annual coupon, but it's paid semi-annually. So we're going to divide that by 2, and that equals $46.25. That's going to be our payment. The par value is 1,000, so 1,000 is our future value, and the price is $10.75. So 1075 change signs is my present value. So recall N, okay, 40, that's right. Recall present value is 1075 negative, that's right. Recall the payment, it's good. Recall the future value, that's good. Now I'm going to compute my rate, and my rate is 4.232845. I'm off the page here, sorry about that. But that's semi-annual, so I'm going to multiply that by 2, and that gives me 8.465689. And the tax rate is 40%, so I'm going to multiply that by 1 minus 0.4, which is 0.6. So times 0.6 equals 5.08%. So it's this guy here. So I'm getting tired just like you would on an exam, so if I make a mistake, I feel your pain. Assume that you're on a financial, is it 102? Yeah. Assume that you're on the financial staff of this company and you've collected the following data. Yield is 7.75%, tax rate is 40, next expected dividend is 65 cents. Dividend is expected to grow at a constant rate of 6% per year. Stock price is 15, flotation is 10. Target capital structure is 45 debt and 55 common equity. What's the weighted average cost of capital? Now this is computation intensive. In one word, there's a lot of places where you can make a mistake. So we've got bonds that are at 7.75%. So I'm going to put this in decimal form. Let me get these on the same level. So debt is 0.0775, and the tax rate is 40%. So I'm going to multiply that by 0.6, 1 minus 0.4. So 0.077, is that the right number? 775 times 0.6 equals 0.0465. So that is my after-tax cost of debt. Now for my equity, 65 cents a share is expected dividend, grows at 6%, price of the stock is 15 per share, the flotation is 10%. Okay, so, well, I'm going to go ahead and write it out, but 0.65 divided by 15 times 0.9. Well, I can see that 15 times 0.9 is 13.5, but we'll go ahead and work our way through it. And that's plus 0.06. Okay, so we've got 15 times 0.9 equals 13.5, and I'm going to divide 0.65 by 13.5, and that equals 4.8, and I'm going to add to it 0.06, and that gives me 0.1081 approximately. And we're going to multiply these by the weights that we were given. This is equity, and this is new equity. The weights that we were given, so we're going to multiply this one times 0.45, and this one times 0.55. So did we do that right? Okay, so this, I've already got this one here, so I'm going to go ahead and multiply it by 0.55 because it's here, times 0.55 equals 0.059481. And up here I've got 0.0465 times 0.45 equals 0.020925, and now I'm going to add them up. It's a weighted average, and so this is the cost of debt, this is the cost of equity. We're going to weight them, 45% debt, 55% equity, so we multiply them out, add it up, and I'm going to add 0.059481 equals, and that comes out to 0.0804. So that answer would be D. And now let's look at the next one. Common stock sells for $45 per share. Company expects to earn $2.75. Expected payout ratio is 70. Again, when they say expects to earn $2.75 during the current year, that means we're talking about time one. It's not time zero. It's not last year. It's this year. So expected payout ratio is 70%. So we've got earnings. We need to calculate dividends by multiplying earnings by 70% because that's the payout ratio. Growth rate is 6%, flotation cost of 8%, so it's just kind of doing the same thing that we've been doing. But, so the cost of equity, new equity, I'll call it that, is D1 over P0 times 1 minus the flotation percentage plus G, and the D1 is equal to 275 times 0.7, and divide that by 45 times 0.92, and add that to the growth rate of 0.06. So 275 times 0.7 is equal to 1.925, and 45 times 0.92 is